my audio? Yeah, we are starting right now. Thank you. Okay, Lee, thanks for that. And I do have the mic and apparently you can at least hear me. Can you see the screen also? Can Lee or somebody, anyone who's there, if you can, as long as you have access, great. Thank you, Thor and Lee. Excellent. So let's commence. Monumental wealth shifts that I perceive and what they translate to in terms of opportunities and speculative opportunities in the markets. So for those of you who have attended previous presentations, you know analytically timing is my area of research. I feel I take it to an extreme view. Timing should always take precedence over price. And so this is an analytical path that I take or approach that I take to forming and locating good trade opportunities. I always start from the standpoint of when a market's time has come to move in a certain way or to stop moving in one way and start moving in an alternate way, then and only then will we see the manifestations in price that we do. So just so for those of you who are not familiar with my approach analytically, this provides, at least in a general sense, an idea of how I form my views and generate my projections and signals. I place a lot of emphasis on time. Doesn't mean I don't take into account price. I do believe that price discounts everything. But from a cause and effect standpoint, I believe that time is the ultimate origin of all the price returns we see. And I realize that's a minority view. Less than probably 5% of all traders worldwide hold a similar view. I believe the best traders of past and present would back me up on that, though. All right, this is a slide that I included in the original presentation again at the beginning of the year, the end of January, and it's a currency pair, dollar Swiss, and this was actually one of the greatest, biggest, most powerful moves I have seen in my 30-plus year trading in the markets. It was in response to an adjustment or that the Central Bank of Switzerland made concerning their currency, and you can see in a one-day move, this is this one big bar. That's one of the largest, most volatile and explosive moves I have seen in 30 years. And so that was then, and it was a multi-sigma event ushering in the beginning of this year, and we've seen a number of similar, well, not quite that large, but similar types of moves in the ensuing months since the beginning of the year. And this is in response to the situation, obviously on the fundamental front. We've got I guess the biggest global situation is the unfolding and evolution of what's going on in the Euro sector with Greece in particular. The question is, today, in fact, June 30th, they had a deadline to make a 1.8 billion payment in, I think, euros, whatever that translates to into US. And thus far, prior to commencing the presentation, I just checked the latest, and they are still in negotiations trying to come up with the funds and look to see whether or not they're going to get a bailout. It's a complicated fundamental issue, but in response to this, look at what happened. This is the front month, the current contract of the September S&P. That's a market I trade extensively in on all time frames, short term and long term. You can see the gap down yesterday. This is again the September E-mini S&P. This is the proxy for a broader equity sector in the United States. And you can see we had a very large range, and we kind of settled yesterday kind of in the mid portion or in the low end of the range. You can see that's where this black area on the price vertical axis is, if you can see that, folks. Sorry for the less than optimal resolution, but if you can see, we settled down near the bottom of the range, and that was quite a move, followed on the heels of a gap down, all in response to concerns concerning what's going to happen with Greece and the response to the euro. Are they going to exit? Will that exiting, if in fact it should occur, serve as a catalyst or a trigger for, or more or less as a contagion for other nations, Portugal, Spain, etc.? We don't know. So I have my own views, but I have determined over the years to try and figure these out, these conundrums and market responses based on pure fundamentals. For me, was not a profitable chore. So when I brought in technical analysis to the mixture, I was able to more frequently generate more probable situations and scenarios. So, but anyway, I just wanted to present this slide as an example of recent. It just happened yesterday, and we're seeing some follow through in some of the major sectors, bonds, stocks, the financials, especially in the last couple of sessions, all anticipating what would happen with Greece. So present volatility. All right, money flows. Money flows always towards greatest rates of return, or at least where it anticipates the greatest rates of return. So from a fundamental or intermarket standpoint, that's a concept that I allow to inform my decision making as well, all for the purpose of locating good opportunities. So again, we all see often major large price returns in stocks, in the equity sector, in the interest rate sector, in currency exchange rate changes and reactions, all in response to money seeking out constantly the greatest point of return. Where can it grow to generate the optimal returns? So that's another kind of macro economic concept that I keep thinking about in one compartment of my brain to enable me to put into context my technical analysis. This was a slide, again, this was the front month at the time bond market chart, a daily chart of March bonds back in the beginning of the year that I presented. So it essentially, in an inverse sense, presents a picture of the cost of money, interest rates. What's money doing? And there's an inverse relationship. As this chart shows the nominal price of bonds, I have a Fibonacci overlay on a portion of the chart just to indicate levels of projected or expected zones of support as the market was moving up. But clearly for months at that point we had been moving up, reflective of a low interest rate and a declining interest rate environment that has been in effect since we have been, as a nation, attempting to pull ourselves out of the recession. And so central bank policy has been instrumental in affecting, to whatever extent we have been able to move away from the recession and create a climate of growth, putting people back to work. Certainly I'm not an economist, but I want to take into account all types of information, be it fundamental, macro, global, economic, etc. Again, at least, and to put into context and to provide the broader stage within which I do my technical analysis, all for the purpose of locating high probability, what will be, I think, profitable trades. And when you have major events that we've seen so far, and I think here we are at mid-course, middle of the year, and the types of events that have occurred, this presents for tremendous wealth shifting opportunities. And so our task as analysts slash market participants, traders, investors, etc., is to try and resolve all of this disparate pieces of information and try and see where the best opportunities lie. That's the whole practical utility of this. All right, so this was a situation in the bond market that I presented in a chart in a slide at the end of January. That was then. This is, and then this is a little follow through, a little elaboration on that. At the time, these vertical lines indicate what I alluded, what a previous slide alluded to, and that's my timing. They indicate time targets that, based on various techniques and models that I utilize, I was able to project when I expected a market to change or to reverse, turning points, as it were. For those of you who listened to presentations I've given in the past, you know that I don't typically formulate trades solely on the basis of my timing models, but they do at least give me a significant edge. And if nothing else, at minimum, cue me as to when I should look for particular price technique or price relationships that would align with the possibility, or for the possibility, of turns to occur or reversals to occur. So these points mark past time points that I've projected. December 16, you see that was fairly accurate. January 5, not so much. And February 5th. At the time this presentation was given, it was in the final week of January, and I had projected a turn for bonds on or around February 5th. So that's reflected by this vertical line out here in the future. Similarly, a price target, the best of all trade situations or scenarios arise, as people like W. DeGan would say, when time and price collide, or when they square. So my price target at the time, if you can see this, at the time I presented this, the market was at 151 and change, 151.28. That was the bond, the nominal bond price of the March bond contract at that time. I had predicted an overhead zone of resistance at about 155, and if we broke through that, 167. So these were my price targets that I felt were most relevant at the end of January of this year. So that was then. Let's move forward to the present, and this is now. This is the current front month bond contract, September. This is the actual top. It's a little sketchy because at the time this was very illiquid. We weren't in that contract. This is the current contract. This is the September bond contract, the 30-year Treasury bond contract. This top here came in actually January 30th. So again, let's revisit the previous slide. I had a theoretical time target of February 5th. It actually came in a few days before, on the end of January, January 30th. So we were given a context of months that was fairly accurate. And my price target, again, going back to the previous slide, 167. The actual basis, the current contract came in at about 169. So we were fairly prescient in terms of both price and time in that. And you can see, since that top came in January 30th, actually, and I had again projected February 5th, we have been declining. The bonds, nominal bond prices have been declining essentially since. We've been able to, I got short bonds, just for the record, around 157, and we just exited, I just exited my short bond position yesterday and reversed, SAR, stop and reverse. We went long, and all of those people and traders who I consult personally through the program at PTA, we're privy to the signal. One way or the other. There are many ways up the mountain, the proverbial mountain, so to speak, but essentially I am expecting near-term appreciation, a reversal of sorts in nominal bond prices. So this, let's go, just so you get the context, let's see, this was the past record of projection. We had very precise forecast for December 16, top, it came in. This was kind of indicating a thrust move in the midst of a move up. This was pretty close. It came within 5 days of the actual top. I had projected February 5th. Actually, that at the time, the June contract came in actually, I think, on February 1st, so I was off by only 4 days there. But the September contract shows a top on January 30th there. So very close, and we came within two bond full handles of the actual high, projecting a 167 top, when basis the September it came in at 169. Not bad considering you're making the projection a few months out in advance. Now, going forward, June 29th, more recently, that was yesterday, I had a projected target for a change not only in bonds and interest rates, but the stock market, and I'll talk more in subsequent slides, a little more in detail and elaborate on that. Curiously, there's a correlation, obviously, between the equity sector and the bond market, obviously. But this is the time target for June 29th, and this is what happened. The bottom came in. Actually, that was the Friday. This was the 26th on that Friday, and here is the 29th. So we were off by, if we discount the weekend, we were off by a day. Pretty good accuracy there, I think. My next projected time point for bonds, July 20th. So that's roughly in a few weeks from now. And then going out further into the future, all the way out into September 16. That's an awful long period of time here, between 720 and 916. There may be some interim time points or rotation points of lesser importance. These three you see on the screen represent a confluence of cyclical and a number of varied approaches that I use, where I get a convergence or alignments occurring, for which correspondingly generate a lot of confidence, high probability for the market to turn. By the way, when I generate my time targets, people, the data itself, the date or the times themselves don't in any way intrinsically indicate whether if and in fact the market will respond to them and react and move in accordance. I don't know at the time I present this data and work it up and it's derived that it's going to manifest as a top or a bottom. Certainly, as you know, in a common sense manner as you get more and more proximal, as the market moves forward through time. We're able to make certain assumptions. If the market's rising, we can assume it's going to manifest as a top, but that's an assumption, implicit with a lot of variables that we need to adjust as we get closer. But it at least gives us a starting point by which we're able to kind of make and conjecture some plausible ways by which we can expect markets to move. And that in turn allows us to set up some possible high probability, potentially profitable entries. Okay, so this is what's going on. I am, by the way, longer term still bearish the bonds, but I expect for the next few weeks to months, if actually a retracement. I'm not yet certain if this is the end of a bear market. I don't think so. I think the move up that I'm projecting, and why in fact I initiated and went long bonds yesterday, is because I think it's going to be a sustainable move. Whether it's the onset of a new bull market, I don't know. I don't think so, but I'm not certain. But I do expect appreciation in the next weeks to possibly month or so, couple of months possibly. So for now, at least between, what this does by projecting a time point, it gives me an indication, some sense of the potential run time for the move. It's a rough estimate, and again, we make ongoing adjustments as deemed appropriate given day by day, moment by moment trade. As we see new types of price return traced out on the screen, we adjust our forecast accordingly to take new information as it presents into account. So the time points essentially enable to kind of serve as my custodian, my rotational guide through the evolution of a market's motion. And then I combine that with the price action. In particular, I use a lot of Elliott wave as a descriptive model, primarily focused on price, to complement my time work. So this is the future rotational picture that I'm projecting for interest rates, or the cost of money in a sense. All right, good. Next slide. This is just an alternate relationship, the commitment of traders report for, again, the bond market. Curiously, it supports my timing and my Elliott structure here. Notice this red line. This is it's not my intent in the presentation right now to go into the details on any particular model or technique or relationship. I merely would hope that I can present in an overview type of fashion the general gist of some disparate ideas that point to opportunities that are obvious for all of you in the audience. And then if you have specific questions, this is the commitment of traders. That's just a financial accounting by our government, the CFTC, every week, that indicates or breaks up derivative markets into three primary sectors. You've got the large and small traders, and you've got commercial activity. What's important to recognize on this slide, folks, is the red line. Notice from mid-April, or between April and May, through the present, it has been rising. So the commercials, and I'm harping on them for a reason, they represent an important faction of market participants. They are in the market and are responsible for anywhere between 70 and 80% of the volume of the market at any given time. And they are in the market for reasons other than what you and I are in the market. They are there as a hedging mechanism to protect primary business. And the reason that's important to understand is they have staying power. Essentially the idea, and I'm oversimplifying just to, again, convey the greater thrust of what I want you to pick up on if you're not intrinsically familiar with this, and that is commercials can move the market. So whatever the direction of their positioning is, it ultimately acts as a harbinger of where we expect prices to go. So the gist of this slide is, notice, since between April and May, we've seen their net long position increasing. And that's the red line, through such that it is at the highest level, or not the highest, but one of the highest levels since that point. It's overall been rising since April. Okay, so while that was occurring, notice the price of the market itself was declining. But again, there is this lag time. The commercial trending ought to be interpreted as a harbinger, as a preview of what the market will do in the future. Now, one of the catches, one of the snafus of analytically, is to try and figure out as precisely as possible what that lag time is. And to the extent you're uncertain is why you don't focus or make a trading decision, let's say, just on the commercial COT or commitment of traders data. But in conjunction with other models, other relationships, other things that you're able to discern, bit by bit, piece by piece, sometimes we're able to codify a more complete picture. And if we pass the threshold of confidence that we have got it right, that's when we are ready to put our money on the line. Even then, often we have to allow for the possibility that error has crept in somewhere along the way in the analytical process, or may in the future. And this is why it's important, those of you who know or have heard me speak in previous presentations, you understand the importance of money management. Having a safety net in place so that in spite of your analytical efforts, you have not picked up on something that could be detrimental to your position, where the market moves adverse to your positioning, you can still preserve the majority of your funds and allow the law of large numbers to work to your advantage. All right, so this is just another small piece of evidence by itself, insufficient to form an opinion, much less place a trade in the bond market. But all of these little bits and pieces of information, again, singularly insufficient to argue for a particular trade. But in aggregate, when you put them all together, it strengthens the case for a trade. And that's what I want to show. Any questions? Let me take a brief, okay, someone, yeah, okay, just everyone looks to be good. Okay, audio is up. Thank you for the feedback. Someone's asked, Rob, or you're asking about the Gann square of 9. Do I use? Certainly. I am a Gann person. When I said at the outset timing is first and foremost as an analytical tool, fundamentally, I qualify that, Rob, yes, because in the scheme of things, at the ultimate precipice of my analytical totem pole is trend. Trend is, so, you know, if I could bring one thing on that desert isle, figuratively speaking, with me, to the exclusion of all else, even though Gann analysis, and you bring up the square of 9, not everyone, that's a more sophisticated technique, and I place great importance on Gann's analysis and his methodologies, and the square of 9 is certainly integral to a lot of what Gann did. Even of greater importance than that to me is pure trend analysis in the way that people like Jimmy Sloman presented in atom theory. But having said that, the problem with trend analysis in the pure way that I apply it is it keeps me in the dark. I may be agnostic as to why it is a market does what it does. One of the virtues and benefits that I can extract and that provides emotional comfort to me in a lot of trading is not, you know, once you get the foundation and the mechanics, the real intricacies and the challenges and often the potential hindrances and roadblocks to be successful as a speculator arise due to what's going on internally in terms of our emotions. And I find that incorporating tools and approaches that Gann in particular utilize, such as the square of 9, often create a added insight and shed light on understanding why it is a market's doing what it's doing. And to some extent, myself in particular, and I think this, I don't think I'm unique in this sense, I think a lot of traders, you know, you have to believe in what you're doing to put it into practice, to implement these ideas. There's a big distinction. I don't want to get too far off on a tangent here for the sake of time, but there's a big, there is analysis and there's trading. They are two separate, distinct disciplines. To be effective as a trader in a dollars and cents metric, you've got to have good analysis. But the analysis, however robust and fine-tuned your analysis is, however great you are as an analyst, doesn't in and of itself guarantee you're going to be successful in terms of seeing your equity in your account, that is money go up. And that suggests that it is first and foremost critical and integral, but it's woefully insufficient to more greatly ensure in the continuum of probabilities that you're going to be successful where dollars and cents are concerned. And so that's my long-winded explanation, Rob, to you. Yes, I certainly utilize Gann, and when I said timing, I use that as a moniker for essentially Gann. And by the way, just so you know, and I'll go on after this, I don't want further elaboration. If we have time at the end, I will. Gann, a deeper insight of W.D. Gann was the equivalency of price and time. at a very deep level. When I look at a price chart, we're looking at the bond chart right now, essentially I've interpreted when I'm doing things correctly as a energy. It's a graphic of collective of energy. This represents the ebb and flow day by day, since I'm looking at a daily chart, of all of the energy of all of the traders worldwide that make up this market, essentially. And this gets to a very deep and more precise understanding of some of the insights of Gann. So yeah, I would elaborate more fully if it were not for time constraints, Rob, but thanks for the question. Yeah, I certainly utilize Gann ideas and tools. Okay. Let's move on here. This is just an argument which by itself would suggest appreciation of the bonds. If you reconcile this, folks, let's think about what's going on. The Fed in the last, since the beginning of the year, our central bank, Janet Yellen, right now has been, I think, appropriately careful, modulated in her approach in terms of when we're going to raise interest rates. I think part of the reason I expect a bidding up of nominal bond prices because the reason the market's been coming down since the beginning of the year is this long-term macro bet that the Fed will raise interest rates. And I believe that's the case. I believe it might not be until 2016. Coming up this week in 2 days, on Thursday, we have the non-farm payroll, I believe. So depending on data that comes out week by week, month by month, the Fed has been consistent in their evaluation and their reporting and indicating that they're going to be data-driven. They're allowing the data on the economy to dictate and to inform them in terms of whether or not and when and to what extent we begin to hike the cost of money and see an interest rate rise. The question right now looming is, are we going to see a hike in interest rates in September? I don't know. I believe it. If you press me, I would say it would probably will be delayed until 2016. And I think in part that's one of the reasons why fundamentally on the macroeconomic front, why I have confidence and why we're expecting this little blip up in nominal bond prices. I think the market's gotten tired of waiting for this interest rate hike to occur, and as such it needs to take a breather and get off the main trend, which is down for a while. And I think in response, that's why we're due for a from the vantage point of its market's time has come to move up for a spell. Okay, related to the cost of money obviously is our money, the US dollar. Here's a chart of the commitment of traders breakdown for dollar. And so right now we have had tremendous strength since the beginning of for the first quarter of this year in dollar, and since then we've had what I believe to be a correction. I still expect further appreciation in dollar, but for the next few weeks to months I expect lower dollar prices. I think we're going to have a correction in the advance in the strength of the dollar. In part, you can see the reasoning behind this. To the extent we delay an interest rate cut or hike, excuse me, we're going to see what I expect will be weakening US dollar prices, and this is confirmed by notice the red line, the commercials are net short. Now, this is not extreme. I want to go back to the previous slide. I want to show something. This is an extra added aspect on the COT as it relates to bond or the interest rates. Not only is the commercial net position increasing their long position, simultaneously, look at this blue line, that's the small traders. 80% of the time when the small traders, as reflected by this blue line here, notice they are declining. So the small traders have been acting kind of in a mirror image way with the commercials. 80% of the time, small specs, as they're referred to, get it wrong. So notice, the small traders are increasing. They are at their maximum. They're at the largest amount of net short position, while the commercials are the mirror image, the exact opposite. That adds more significant. That makes this relationship that much more significant. 80% of the time, this blue line positioning essentially you can utilize as an indication. Play the contrarian. Whatever it is that they're doing, do the opposite, because 80% of the time they get it wrong. So when you have this extreme position, and you don't see this that often, when you see the commercials antithetical to the small traders, not the green line of the large, those are investment funds, hedge funds, money funds, commodity pools, etc. But when you see the blue line acting opposite, or the 180-degree opposite of what the commercials, the red line, are doing, which we have at this point in time, very important. Because you don't see that. That happens less than probably 20% of the time, maybe 15 to 20%. 80% of the time you have the commercial activity opposite of the large speculators, which stands to reason. The large specs, the major money funds, will spend and do everything they can to spend most of their time in sync with the market, because that's their objective, to take money out of the market. Whereas the small traders, the blue line, that's their objective. They're just not very effective in the net at doing it. So whatever they are doing, and they are getting more and more short, that's an indication they are at this moment wrong. And the fact that simultaneously it's opposite the positioning of the commercials further exacerbates or emphasizes this relationship. All right, we don't have that as extreme. Here you have a more normal situation on the US dollar commitment of traders chart. You see commercials net short, so that's in a qualitative sense why I'm projecting temporarily lower US dollar. We need a correction. I think there's further appreciation going out after 6 months or so into the end of the year, but right now in this quarter, as we begin this new quarter, I expect a pullback in US dollar prices. The dollar needs a respite, and fundamentally a factor. If we see a further delay on the part of our central bank and Janet Yellen for the bank to raise rates, that's going to serve, I think, to put pressure on U.S. currency prices somewhat. This is cloud cover. This was one of the primary fundamental world events at the beginning of the year. We went long Japan, or excuse me, we went short Japan, long the dollar. And so these were the cloud cover, as I figuratively referred to it at the beginning of first quarter of this year, at the end of January. They were Japan, and they still were, and still is to a lesser extent. They're working on it. 150% debt to GDP. Debt is 29% of revenue. You can see, I won't go through this, but this was just a primary, a gloomy event concerning Asia and Japan in particular at the beginning of the year. This has been going on for years, and it was a major driver of increased volatility in the currency sector and spot market in particular. That was then. This is just a breakdown in the Elliott wave structure that we presented at a slide back there. This is my wave one. This is a spot dollar yen chart. So when this chart rises, you're seeing it's reflective of appreciation or strength in the US dollar against or in comparison to the Japanese yen. This was my wave count that was accounting for it. Wave one there, wave two, all the way up to wave three. We had a triangular wave four. Again, this is Elliott wave. For those of you who are familiar with it, great. If you aren't, don't worry. I just want you to see a flow and the big picture projections that we were making at that point. And so and then I'll bring you up to the present and show a new event and a new situation that I think will offer a good opportunity for profit. At the time, I projected in yen prices, and you could be traded or exploited in the dollar yen. You can trade it in the yen in the futures. You can trade an ETF for those of you on the security side, or you can trade in the cash currency spot market. At that time, I projected a turning point February 4th. You can see that February 4th was this vertical crosshairs indicated a turning point in time that I had projected. In my thinking, trying to reconcile my market timing with Elliott wave, I said, given the structure in price, that could reconcile with it marking the end of correction wave number 4 and an opportune time from which to go long with the expectation based on my Elliott count and description for the market to move up, that is rising dollar values and declining Japanese yen values, in order to form what would be a fifth wave from the context of Elliott wave, for those of you who are familiar with the Elliott principle. Well, this is the slide that I presented at the end of January. Well, and then just to further put this in the context, at that time I said the big question for policymakers is whether Japan can skirt the faltering economies in Asia and Europe. without having to ease for a third time, cut interest rates. And at that point, they couldn't cut any further, which some fear could trigger a damaging decline in already weakened yen. All right. Well, insolvency, this was just setting up at that time what would have been and was in fact in retrospect, a long-term position trade in dollar yen, or to go long in the dollar one way or the other, or if you were directly trading the yen, short the yen. Insolvency would further weaken the currency. So again, this arrow was pointing to a conceivable point of entry for a longer term trade to go long the dollar or go short the yen. Again, consistent with the Gann idea or concept, and Gann, by the way, wasn't the only one, but others like him, this concept where you get your best trades when price and time square or balance or run into each other, collide. So I had a time point, February 4th, and I had also, I'm sure, worked out a price point. This is a triangle. There are Fibonacci relationships that enable more precise projections of price, but suffice it to say, this is your A, B, C, D, I didn't mark those on the slide, of a triangle. And then the E would be marked the price point at which I would have projected the end of the fourth wave and the onset of the fifth wave, impulsive wave, taking dollar to higher prices and the yen to lower prices. So this was a setup slide that I presented back in January. And this is the present. This was printed out yesterday. This is the same. This vertical time point indicates my projection for a turn in the market, February 4, and you can see it came in fairly, this is pretty prescient, pretty accurate there. This was marking 4, this is your end of your impulsive wave 3, and you can see the triangle here if you can. You can see the descending tops and the simultaneous rising bottoms, creating that triangular convergence structure for those of you, again, who are familiar with Elliott wave. Bottom line, whether you are or not is less important. What's important is that we established long-term positions in dollar yen, or long-term shorts, long-term long positions in dollar yen, or long-term shorts in Japanese yen. And you can see what happened. Again, go back for context. This is back when we presented this in January, the beginning of the year, the last month of the first quarter. And so we were anticipating and did go long on or around February 4th in that week or so. That's what we did or talked about and actually did, and this is what happened. You can see up the fifth wave, up to the recent top here, and we moved to just under 126. I think we're going higher. I just think right now the market needs a brief respite, if you will. I don't think this is the end of the dollar appreciation and the yen strengthening, or I don't think this is the end of the troubles for Japan. I think it's a pullback or a correction or a retracement in a otherwise still generic bull market in the US dollar. Okay, but in the meantime, I think there's an opportunity that presents right now. This is the top recently, earlier in the month, in June, and I expect further declines to ensue given where we are, given the wave count and projections that we have made for these markets. So that's another situation. Any questions with regard to, just let me take a quick review of the panel here. And someone said not happening. I'm not sure. So do I expect S&P to go down till July 20th? No. Whoever asked that question, I got out of my shorts. If I got out of my most of my shorts, 80% last Friday in the S&P. I'd been short from 20. Well, I'm short from a number of different levels in the S&P, but suffice it to say, we exited all of our shorts in the bond market yesterday and the equity and the S&P, and reversed. And I worked orders. I'm long from 2058 in the S&P. So the answer is no. But I have my next time target, as you'll see, for stocks coming up on August 19th, as a subsequent slide will indicate. So it took a lot of courage, because that's essentially, in a figurative sense, getting in front of, from a trend perspective, an oncoming freight trend. After seeing a big move, and again, I alluded to this, I glossed over this a few minutes ago. Let me come back to it, because this is critical from an analytical standpoint, and it highlights a more nuanced, very integral and important point of trading. It's easy in a cold sense, in a sterile, when I don't have money on the line, easy analytically to sit there and say, do this, do that. They're typically, at least for me, and I think for most of us, because we're humans before we're traders, to uh, uh, disregard and discount completely an additional dynamic that comes into play when actual dollars and cents are on the line, when you know it's not a SIM or a DEMO account, and your decisions have financial dollar and cent ramifications. So when I looked at the gap down yesterday, and I've, my entire life, Dr. Alan Larson told me many years ago, when you see a gap, what you'll find in most textbooks and most treatises and theoretical discourse on gaps is they will be filled. Everyone knows that who's been trading for any length of time. More importantly than the concept of a gap being filled is that interpret the gap as a sign of strength in the direction of the gap. So when you had high volume, high volatility, high open interest, and on the heels of a gap, long range, all going to the downside yesterday in the equity sector, and for me to get out of all of my shorts and to place, now, admittedly, I was somewhat chicken because I could have gone long on the market. I had so much confidence in my time target for both the bonds and the stock sector, the equities, on June 29th. Curiously or coincidentally or not, I'm not sure, it was both. But that's the extent to which I place evidence when I do in the GAN stuff, because I had 90% probability of expectation of reliability on June 29th that I had projected months ago for equities and bonds to change. But when I saw the price, the activity and the trade yesterday to do that, so I mean, to be fearless, I would have just SAR'd, stop and reverse. I didn't quite do that. My strategic concept was to just work buy stops, a couple of levels of resistance over the market. For those of you who are seasoned traders know what I mean. If you're beginning, don't worry, you just catch the idea here. The idea was to work buy stops, a couple of zones of resistance above the market, such that if the market, essentially play it as a contingency, if the market continued to drop, no problem, I don't lose any money. And the idea is it would take a substantial reversal, not just intraday volatility, to get my buy stop elected. We'll see, the jury's still out, but I'm long from essentially on average 2058. So we'll see. So no, I did not continue. I stopped and reversed in an incremental fashion. I didn't immediately do it all in one step. So do I expect the S&P to go down till July 20th? No, my next time target is not that. The S&P, the July 20th time point was for the bond market. I have a separate, it just coincidentally, I had the same exact time point for both bonds and stock market for yesterday, June 29th. Actually, it was June 28th, but whenever it comes in on a weekend, you go to the next day, June 29th. It turns out my rotation for equities and stocks, they decorrelate for the two markets. For the stock sector, my next time point is August 19th. The next one for the bonds is July 20th. So, but the answer would be yes, if it, in principle, that would be my starting point. So more or less, I expect stocks to move up more or less into the next time target point. But not that. But your question was for the bonds, so I would expect the bonds to move up more or less more or less, not in a straight line. That would be too easy to expect. More or less into the next projected time point, which is July 20th. Okay. Any other questions? Okay, let's proceed here. All right. So this is the dollar-yen situation, and let's move on. This is, okay, a related market. Another a sector, energy and in oil in particular, has been another capital market or sector of the economy that has had tremendous ramifications. One of the very best, I will toot my horn here, one of the best trades of my entire career. This was a setup, this was a slide again from the presentation we gave at the end of January, at the end of the first quarter of this year, where I was projecting and presenting a strategy, plausible ideas for going short in oil. And this is a GAN technique here. This is an idea that I use without going into the details of it. By the way, these vertical lines were time targets. All the vertical lines, blue vertical lines that you see here, not this one here. this one right here, this right here, this right here, this and this were past time points that I had projected for oil, for crude oil in particular. This was the May crude oil at that time. It was a front month contract in oil. And this is just a Fibonacci overlay. And what I was presenting in the presentation back in January was, to be conservative, I said, if you go short oil on a break of this line that's moving up kind of at a northeasterly tilt there. And you can see what happened. We got short, for those traders that follow my signals, we got short just over $66 a barrel, and took it, and we made over $13 per barrel per contract in this position. We got out, and then we went to the sidelines and we shorted it again, but the primary trade was based on a crossing of this. If you wanted to, I was actually a little more aggressive, but essentially on average, I think we were at 66.13 or something, or somewhere in there, where we sold the front month in oil, and you can see the subsequent trajectory of the prices down to the bottom. Okay, so this was a situation, this was a setup that I had presented to in a presentation in the first quarter of this year. Let's move us forward to the present. This is the current commitment of traders report for oil. You can see we've had off of that bottom. Let's go back just to put it into context. You can see the little double bottom here, and then this is the current chart print. Oh, went in the wrong direction. This is the current chart printed out, a daily chart of August oil printed out yesterday, and the corresponding economic data or the commitment of traders from the government data. Daily chart of oil, we can read, we've had a little correction. I interpret it as a correction. Curiously enough, 10 minutes before I got on with you folks today, I read a report on a financial site about the new upcoming bull market in oil, which years ago that would have caused me some concern when I was beginning. I kind of like it when I am not seeing reports in the economic chatter out there on all the sites and the conduits and avenues of financial information, financial networks and so forth that agree with me. The more people that don't see it the way I see, the more confidence I have learned to engender in my own analysis. Essentially, look at the numbers, look at the data, be objective. Especially, there's so much, the attempts at separating the signal from the noise, the signal to noise ratio. If I attempt to do that solely on fundamentals, I personally was not able to do it in the beginning of my career. When I began to incorporate more of an objective technical approach, allowing the market to read the market as best I can given the tools that I utilize, I began to see dollar and cent returns more consistent with my ultimate objectives and the reason why I got in this business in the first place. But what's important on this slide is notice the red line, again, commercials. The blue line is the small traders. Again, they have it wrong most of the time. So commercials are net short, and they are at their most extreme net short. They are the greatest level of net short positioning that they have been in since the beginning of the year. It's actually, I could have taken this back further. It's for more than a year, but this is just showing just since January. While the the blue line, the small traders, who again have it incorrect 80% of the time, have position. Now, they're not opposite. They're not polar opposite. What would even render this picture of greater, what would impute more significance to it, would be if the blue line were in place of the green line. But they're still opposite, so it means it's very significant. It could be more significant if this blue line were in the position of the green line. But the fact that the blue line, reflecting graphically the position of the small speculators, as they're referred to, the small specs, which have it wrong most of the time, are opposite the positioning of the commercials, lends strength to my bearish view, and I am in fact, I am short oil and will be looking probably to add to existing shorts. Currently, I haven't sent out a signal yet. I'm waiting for some additional price confirmation, but I have my time targets. My next time target for oil, by the way, is July 14. Again, when I project a time point by itself, it does not indicate, I don't know at the time I generate that information, that date or point in time, whether or not it will correspond to a bottom or a top, if and in fact the market is responsive and is sensitive to it, whether it's an accurate call, so to speak. But assuming it is accurate, again, to reiterate in a very simple form, it's not, I'm oversimplifying for the purpose of presentation to convey the primary thrust here. Initially, as the market trends, as it gets more, as you get closer and closer, as the market becomes ever more proximal to your projected data, you can assume if the market's trending higher as we get closer to July 14, I would assume it's going to be a top from which, and as such, we have an opportune trade to go short. I'll trade the reversal, as it were. Alternatively, if the market is trending lower as we arrive at our projected time point, my initial thought would be to trade the reversal to look to establish longs or add to existing longs, etc. So this is my part of the argument. It's certainly not the entirety of my case for bearishness in oil. Certainly not. I'm aware of the fundamentals. I'm aware of the decreasing rig count in the fracking going on here in the U.S. I'm also aware of the policy primarily of OPEC, out of OPEC. My previous, as you'll see on a subsequent slide in a minute, you'll see my previous time target for oil was June 1st. Curiously enough, very close to, I don't believe it's coincident. I think that was quite a prescient. The analysis led me to generate that, curiously proximal to the June 5 OPEC meeting, where the policies out of Riyadh, even though the meeting was in Vienna, seemed, but I think it's mainly the primary spokesperson for OPEC is the Saudi thought right now, where we're talking about, if anything, increasing production, not decreasing or cutting back. And as such, overall, in total, without going through the item-by-item line accounting of it, as I did in a previous webinar on oil, I still expect lower oil prices prior to, by the end of the year, we may be up at $80 oil, but not right now. I think right now, for the shorter term, next few months, I expect lower prices before we see a return to $70 or $80 oil. Okay. And this is reflected by the report. So here we go. Here's what I just alluded to. This is the current chart, a little more of data and history. This is the last time target that I projected for oil. You can see it came in near a top. I don't know if that was tradable or not. It is what it is. Some of these things are quite blatant and obvious and stick out in a salient way. Others are less. Again, from a practical standpoint, in terms of strategy, I'm not suggesting or implying you place a trade solely on timing. Although, there are some situations for which if I have over 90% confidence in a time target, I may. But that's a separate issue, and depending on what you're doing strategically and analytically. But in principle, to the extent I see a time target, or I generate time information, it serves at minimum as a complement to my price analysis. So when I have price and time squaring, as Gann and Jensen and Robert Miner, people like today, and Michael Jenkins, Larry Pesavento, who else? There's a number, Robert Krauss, all of these people, the school out of analytical thought out of which I arise, would argue and agree with me on these. You at least, and Jeannie Long is another big cycle person, I work on up the timing, and that more or less allows me to see a potential roadmap of rotations by which I can then make better sense of what the price is doing in the market. And I have at least sometimes when the analysis is at its best, plausible understanding and explanation for why I'm seeing what the market's doing. And that enables me to have greater confidence going ahead into the future to locate good high probability value areas. Okay, so this is our forecast. This is where we've been. June 1st correlated very, I think, not by coincidence with the OPEC meeting. That was on a Monday. June 5th was that Friday where that's happened, and I expect we're going to more or less, now you can see thus far more or less sideways, more or less, between, if you look at it in the big sense, from ever since the first week to where we are now, we're more or less going sideways. But if anything, I would say price-wise there's a slight bias to the downside. We shall see. All I know is that I have projected, what I know for sure is that I have projected a time point for this market coming in in another 2 weeks or so. All right, so that's oil. And we shall see if with declining oil prices, we also want to factor in from a standpoint of how different sectors, different capital market sectors from an intermarket relationship, whether or not they support a particular view that as a technician you're working up. So all of my signals and analysis ultimately it reflects a resolved accounting of all of the information, be it fundamental, be it technical, be it cyclical, be it market timing, you name it. These are just different labels that analysts and traders put on different types of information to give us context in understanding. But it's all information, and I jokingly tell people facetiously to get their attention, information is just the little container that carries the energy that enables, if it's of the right type and of the right frequency and of the right character and quality, to disturb a market from one trend and get it off one track and change its trend to an alternate track, or move from an uptrend to a downtrend, or vice versa. So barring that, and to the credence and to the deference of the trend analysis, left to its own devices, a market would continue to move on a given track. But information, if an event that occurs in the world, if it's of the right type and character and quality, and if it packs and contains enough energy, then and only then will it enable the first law of motion that Isaac Newton came up with to disturb that system and enable that system, that what we call a financial market, be it a stock or a commodity or a currency pair, etc., to stop doing what it was doing previously and get on board a different route and a different tack and assume a different trend. All right. So this slide, folks, presents my generic overview structurally of the different, I realize now I left out the precious metal sector, gold or silver or platinum. A lot of people in the last 2 months have been asking me, Glenn, is it time to buy gold? Is it time to buy gold? I don't know, but I don't know that it is. I don't know that it's not. I just don't know. And I did some analysis last night. It's inconclusive, and that's part of the reason why I haven't put this here, because I'm having some challenges working up some data for the timing on gold. Whenever I've presented my time analysis, I don't want to give the impression in doing that, when you see those vertical lines marking out future points in time that I've projected I can expect a market to turn, it doesn't, every time I sit down and look at a chart and consider a market and apply my tools of analysis to generate a future time point, sometimes the structure of the market is not conducive, or is less than cooperative in terms of lending its activity to the model that I utilize. It turns out that the precious metal sector has been less than perfectly cooperative and doesn't reconcile and dovetail with some of the analytical models that I am familiar with. And as such, I understand where we are from a price perspective, but that typically for me is insufficient of an amount of information and a type of information from which to launch a trade and ultimately put my money on the line. I would prefer, in the scheme of things, in the best scenario, to have both price and time, where I know that the odds are significantly to the exclusion of the masses of traders out there in the world in my side of the corner. And that's really where I think I have considerable edge. But as an overview here, I am expecting euro currency, curiously enough, in the light of what's going on in Europe. I think the euro here is I expect appreciation. Technically, the confluence of everything I'm looking at, I'm hearing a lot of clouds on the horizon in terms of, if I pay attention to the news, will Greece secede and make an exit from the European Union? Will that, if they do, will that serve as a catalyst for other nations? Will there be a collapse? What will this portend for dollar-denominated assets in Europe? Will this be a trigger for global collapse? I don't think so. I might, if I solely focused on the events, event by event, from a fundamental perspective. Technically, I expect appreciation in euro currency based on everything I look at. Similarly, and this is a window of time for the next few months. So this is short term, if that's short term, but to be precise in designating the window or my time horizon for which these directional cues are indicating, I expect in the next 2 to 3 months. This is the course or direction of activity for these respective markets that I'm listing on this page. So the yen is up, the euro is up, US dollar down, US stocks up, oil down, bonds up. So this is representative of some, if not all, of the major sectors that I think we can exploit for a profit. Again, those traders that I work with and consult are privy to some of the signals that I generate, where we currently If one was on the sidelines, we initiated a long yesterday in equities in a stock where I trade the E-mini S&P, but geometrically, whether you trade the Dow, the NASDAQ, the Russell, an ETF, etc., and how you do it, whether you do an options play, etc., or trade the direct underlying instrument, there is always a way. The nuances and the specifics of strategic approach ought to reflect, in my estimation, the particulars that differentiate you from one trader and another, key among them being your equity and your tolerances for risk, and etc. And that's one of the things that I do to tailor strategies to the individual trader, because you can't, in the real world, we can't treat a viewpoint as homogeneous for every trader. There's got to be a differentiation as to how one trader would do it, taking into account their acceptance of risk, how much money they have, their tolerance for loss, etc., things like that, and their comfort level and what instruments they may be familiar with and how their account is set up and so forth and so on. And in particular, so we're currently long in stocks, short in oil, and long in the bonds. We have been short in the bonds. Again, we got short in the bonds at 157, got out on average around 151. Yesterday, and then simultaneously went long in the bond market. So that reflects our current positioning. This final slide, folks, represents just I've gotten in the habit of presenting some past and future time targets for the stock market. I don't want to indicate that I only trade in the stock index. Curiously enough, I started my career 34 or 30, almost 35 years ago at Merrill Lynch as a broker and was trading individual stocks. I haven't traded individual equities in my own accounts for about 8 or 9 years now. To me, the purest part of my brain is a technician, and they represent lines on a screen. So whether I'm trading the S&P or I was in a meeting one time years ago, curiously enough, with Larry Williams, and someone made a comment, I don't care if I'm trading a soybean or a jelly bean, I just want to make money. So that purest part of my technical analysis brain is, I kind of relate to that concept. And so these dates represent time targets for the broader equity sector. Again, I do the analysis specifically on the E-mini S&P. These are some of the past turning points that I projected, so you get a sense of the record. This was today, or yesterday, June 29th. This is August 19th, moving out into the future. Time target for the stocks, or in general in the U.S., and then beyond that, September 22nd. And as we go on and as we pass or reach any given time point on the calendar or timeline and then move away from it, then on an ongoing basis, I continue the analytical procedures to generate future time targets. By the way, for the short-term traders, again, the theme and the topic for today was to point out the volatility and the events as I see them and what my analysis makes of them for basically swing or position trades, longer term trading. Conceptually, the models that I utilize for the most part, and again, I use timing, Gann, Elliott, trend, I'm pretty much aware after 30 plus years of most of the types of tools and indicators and relationships that are out there. But I, in general, am a minimalist and choose to utilize and focus primarily on the things that have worked in combination the best for me, and they are, again, Gann and Elliott and trend, to cite the 3 top items probably. So these are some future dates that we have projected for the stock market. I can similarly work up a spectrum of time targets, both long-term and short-term. In principle, a number of the tools that I utilize and projection methodologies and models that I apply and implement to generate time targets for longer-term projections, I would scale down for day trading. I would just calibrate everything in terms of minutes, let's say. Well, there are some exceptions, for ultra short-term trading that take into account particular environmental differences when you get down to very, very short-term realms on a 60-second chart or a tick chart, etc. But in principle, theoretically, 80% or if not more of the concepts that apply for longer-term projections, both in price and time, will apply as you cross or crisscross between time horizons from ultra long term to ultra short, very short term. Let's see, I'm at the end of the presentation. Are there any final questions or anything? Let me just see if I missed anything. Do I expect the S&P to go down? No, more or less I'd be expecting the S&P right now to go up. Longer term, by the way, now there will be, again, for the S&P, my you can see here's the time targets. Here's where I think yesterday represents an extreme move into a bottom, and overall I would be expecting appreciation into August 19. Now, this is rather, this is about 7.5 week interval here. So I've got to take into account the plausibility that there may be interim rotations here. So it may not be that August 19 will be a top. These data points don't implicitly by themselves suggest the market's going to go like a straight line from a bottom that formed yesterday to a top August 19 and then go down to a bottom on 9/22. I wish it were that simple. No, I don't wish it were not. I'm glad that it's not that simple, because if it were, an interesting irony of analysis is that if it were that simple, again, folks, here's a deeper point, critical point, nuanced point, everyone would understand this. And to that extent, you would see the veracity, the reliability, the accuracy of these modular concepts begin to trail off. That's a subtle point. For those of you who catch it, great. For those who don't, this is why we teach. This is why it's a continual path where I hope, for all of us, myself included, I hope I know more 5 years from now than I do now. I certainly know more now than I did 5 years ago. And it's scary. If I had made that analogy or shown that ratio of understanding in terms of development over the course of time, early in my career, when I first started, what's really scary for most of us, certainly myself, is that when you learn a little bit, I was dangerous. When I learned a little bit, I was dangerous to myself and everyone around me within a 100-mile radius. But I didn't know it, and that's what would increase the degree of danger. Once you get to a point where you learn enough that you know that you could be dangerous until you learn more, that's when you begin to see fruit and the results in a tangible way. Folks, we are near the ending of our presentation, and if there are any questions, again, we have recorded today's presentation. Oh, thank you for the compliment, Dan. Outstanding that I'm glad that you found it such. Again, it's difficult in the context of a hour-plus presentation to go into detail on any one particular technique. It's not the intent of that. It's more in this case, and I have done some webinars where I specifically teach, say, an aspect of Elliott wave, or an aspect of Gann, or an aspect of trend analysis, or an aspect of trailing stop adjustment, or option, volatility, or understanding the VIX, or I did a presentation about a year ago on utilizing average true range as an indicator. There's a myriad and an infinite number of possibilities of topics, and I love it. Those of you who are new probably have been able to feel the enthusiasm that I have for this business. I have been fortunate, and I got into this business again at 24 years old. I'm 59 by accident, by default. I was heading at that time at in my early 20s on a completely different career trajectory, and had the good fortune of meeting a guy who was a year younger than me, who was a multimillionaire, and turned me on so much that I am here today speaking with you without including the detail, the step-by-step increments that enabled me to get to where I am today. But I appreciate that you see it, and let's see here. This is, again, if you'd like to learn anything about the details of what I teach, what I do, how I do it, and more specifically, you want to talk to a gentleman named Peter Newman. He handles our business at Pacific Trading and admissions, and he handles all of the details of that. I am one of the mentors there, and we have a number of them, but in particular, he works with me in finalizing and presenting details concerning the programs. And for those of you who just want to hang on a moment, he is here with us today, and I'm going to let him say a few words. This is the first time he's actually been. He came by my office earlier, and he didn't even know that I was doing a presentation. And for those of you, he'll talk to you a little bit for a brief moment about what we do as an organization. So here's Peter Newman for those of you who'd like to listen.
Good afternoon, everyone. This is Peter Newman. Greetings from the PTA Business Affairs Office. I hope that you've enjoyed Glenn's webinar, which I'm sure you have. I'd first like to thank you for your continued support. We are so very much appreciative of all that you've given us back in terms of feedback and coming to our webinars. We really appreciate that. And I'm often asked, how has PTA been able to survive and maintain its high standards and its integrity throughout the years. And I've always said the answer is rather easy, in that our mentors are trading professionals who are not only motivated by trading, but they also really love teaching. And believe it or not, there are still a few around. If you remember your favorite teacher when you were growing up, probably whether in high school or college, that teacher probably was great because they really loved teaching. And Glenn Thompson, as I'm sure you probably already know, is one of them. And in light of this, in about an hour or so, I'm very excited to let you know that I hope to be speaking with you. I'm going to give you a call with an opportunity that we'll be extending to hopefully maybe 3 to 5 individuals who would like to participate in a brand new program launch that we are going to start right now. We've never done anything like this before. And I can say, should you decide to be a part of it, I guarantee, or I should say we guarantee, that your trading world will be forever changed in a positive financial and measurable way for the better. So I look forward to speaking with each one of you, hopefully this afternoon. I am going to promise that it's going to be great and something that you will not want to miss. I thank you for your continued support. PTA looks forward to building great wealth and financial independence with you. This is Peter Newman. Thank you very much, and I look forward to speaking with you soon. And I'll give the reins back over to Glenn.
Well, folks, that's it for today. And if there are no more questions, that was again Peter from our business office. Let's see, I'm just checking. I don't think there are any questions. If there were, oh, thank you, VJ, for your thanks and for showing up. And we'll talk later. And anyone, if we have a few minutes, but I don't see any questions, so I appreciate it, and then look forward to future topics in the weeks and months ahead. And until that time, I wish you all, in the sound of my voice, a great day and profitable trading in the days and weeks to come. Look forward to talking to you then. Bye-bye for now.